So we are now in the last month of 2025 and Perth's story has actually tightened, not cooled. Back in spring, a lot of people were waiting for the normal release valve to kick in. More listings, more choice, and a little bit of breathing room. But that valve didn't open. And when supply doesn't arrive and demand just remains steady, you don't get a gentle upswing. You get a sharp acceleration. The type of acceleration that starts to feel too hot, even if the underlying mechanics are pretty simple. So guys, in today's video, I'm gonna show you exactly what the December data is saying, what has changed since the last update that I provided, what hasn't changed at all, and the two things that I'd be doing differently heading into 2026 now that Perth has a realistic path to a 12 to 15% year. And that's even if this market refuses to provide us with more stock. Guys, my name's Josh, I'm from DataEdge Property, and I help everyday Australians navigate the Australian property market using data. Data that's accessible to absolutely everyone. And if you get value out of today's video, make sure you hit the like button and subscribe so you can continue receiving data-driven updates just like this. With that said, let's dive straight into where Perth sits right now. And let's start with the growth pulse because this is where Perth has surprised a lot of people. I'll bring up the most recent data out from Cotality, which reads that Perth is up 2.4% in the most recent month alone, up 7.4% over the last quarter and 13.1% over the year, and it's currently sitting at a record high with median prices exceeding $900,000. And that 7.4% figure is the one that should make you sit up right away because a quarterly pace like that is not steady growth. It's a market saying that I cannot find enough sellers, so I'm going to reprice very quickly. Now, here's the part that most people miss. You can actually have a market that's moving strongly upwards without it being a broad-based everything is booming scenario. What you tend to see instead is a rotation. First, the affordable pockets run. Then, buyers are forced to move up the quality curve. And that's exactly the dynamic I want to unpack today, because it changes how you invest from here. And guys, if you're serious about using data to build real wealth through property, don't just watch from the sidelines. Make sure you join my completely free DataEdge property community on Facebook right now. I share breakdowns there before they ever hit YouTube. Check it out in the link in the description down below. And with that said, let's jump into the market mechanics, which prove that the spring rebound that everyone was expecting in Perth, it never arrived. You see, back in my September market update, the setup was basically that supply was anemic, demand was holding up, and prices were steadily rising, and that the only release valve was spring listings. So let's test that in the December numbers straight out from REWA. Right now, total properties listed for sale are sitting around 2,759. 4 weeks ago, that figure was at 2,942. So listings definitely didn't rise into the year end. They actually fell. And compared to the same week last year, listings were at about 5,500. That's basically a 50% drop year on year in available stock. And that's the entire point. If the market was going to cool naturally, you'd see it in supply first. You'd see more choice come back, you'd see sellers testing the market, and you'd see a bit more days on market. But instead, let's look at the demand side, and we can see that weekly sales volumes are still basically where they were same time last year. Total sales this week are sitting at about 968 versus 986 the same week last year. And that's definitely not demand collapsing. That's demand holding steady. And if we just compare that against the supply levels of roughly 2.8K, that tells us that Perth just has 3 weeks of supply left. So if nothing new comes to the market today, then in 3 weeks, there will be nothing left. So you've effectively got this disastrous combination of sales staying steady, listings being dramatically lower, and this is how you get price pressure that refuses to fade. And this lines up with the listings data that's coming out of Cotality. If you look at this chart, you can see that total listings in Perth over the 4 weeks to late November were down 30% compared to same period last year. So when we say that spring listings never arrived, that's not a vibe, that's the data. And the supply that usually gives buyers relief simply did not show up this time around. And now the question becomes, if listings aren't coming back, where does the pressure go next? Because it doesn't hit every suburb the same way. And guys, if you want to learn how to assess individual properties, not just the broader market, make sure you grab my completely free property due diligence checklist in the description box down below. It shows you how to analyze land quality, zoning, and tenant demand so you don't buy the wrong asset in the right market. And just a quick heads up, the data tells me that over 90% of you who watch my videos are not subscribed. So if you find this kind of breakdown useful, make sure you're subscribed so you don't miss more videos like this coming out soon. With that said, let's jump into the real story, which is that Perth's prices are re-rating up the quality curve. You see, when a market is supply choked for this long, buyers adapt in a really specific sequence. Stage 1 is the obvious one, and it's the one that we've seen in the last few years. Buyers chase affordability. The lower quartile, it runs super hard, and anything livable, rentable, and good enough gets bid up very quickly. That was the earlier Perth phase. And you can see that on this chart from Cotality, which actually breaks up the different price segments and the rate of growth that they're experiencing. And this is for the last 3 months to November. And you can see that the pace of growth is still being led by the affordable and even the mid-market. But you can see that it's beginning to even out. And that's where stage 2 is even more interesting. And it's where the opportunity still exists for selective buyers. You see, once the affordable stock is repriced, buyers don't stop. They just move. They move into the middle bands, they stretch for better land, better school zones, better proximity, better amenity, better build quality, and fewer compromises. And that's why even with Perth up extremely strongly over the last 4 years, I'm not sitting here saying that it's done. I'm saying that the type of growth changes from here on in. The market stops being about anything in Perth and starts being about the right Perth. And that's also why, if you're trying to invest in Perth heading into 2026, the biggest mistake, it isn't being too late. The biggest mistake is buying the wrong asset inside the right city, because the dispersion gets wider as the cycle matures. But guys, here's a quick question for you. Do you think that Perth will get more stock in 2026? Or do you think that sellers will continue to sit on their hands? Make sure you drop your thoughts below. I read everyone and endeavor to respond to as many of you as I can. With that said, let's do a quick yield compression check, and that tells us a lot about where Perth is in its cycle. You see, instead of focusing on short-term price momentum, there's actually a much cleaner way to understand where Perth actually sits in its cycle. And that's through gross rental yields. You see, since September, Perth's yields have compressed materially. Back then, Perth's houses had a yield of around 4.3%. And if we look at the most recent data out from Cotality, it shows us that Perth's house yields are now sitting at closer to 3.9%, as prices have continued to rise faster than rents. And that shift, it matters. Yield compression like this is a classic late cycle signal, but context is everything. In the last Perth boom, yields didn't bottom out at 4%. They pushed well into the mid 3% range before the cycle genuinely rolled over. At 3.9%, Perth is clearly in its second win phase, but it's not yet at historical exhaustion levels. So 2 things are happening at once. First, Perth is no longer a pure yield story. Capital growth expectations are now doing much more of the heavy lifting, which is exactly what you would expect once a market reprices risk. But second, from a historical perspective, the yield compression that we've seen so far is consistent with a maturing upswing, not a finished one. And this reframes the entire question for 2026. It's not whether Perth eventually slows. Every market does. It's whether yields compress further because prices keep pushing, or whether growth rotates into higher quality assets where buyers are willing to accept lower yields for better long-term fundamentals. And that distinction is what separates disciplined late cycle buying from blind momentum chasing. And guys, if you want to see the macro context behind all of this, why rate cuts are likely done and what this actually means for property heading into 2026, make sure you watch my video on what interest rates are likely to do heading into next year and what this means for property. It's linked on screen and in the description box down below. Make sure you check it out right after this. Alright, with all of that said, let's touch on what I'd be doing differently now based on where Perth sits in its current cycle. Firstly, I'd stop waiting for the normal seasonality to save me. Perth just proved that it can run through spring without giving buyers any more stock. So if you're planning your strategy around, I'll just wait for more listings, well, you're basically outsourcing your outcomes to a thing that may not happen. The better approach is to buy with a clear set of rules and criteria, not a suburb list, rules, minimum land component, minimum street quality, minimum proximity to employment or transport nodes, a clear ceiling on property type risk. You see, if you can't describe why your asset will be the one that both renters and owner occupiers will be fighting over in a tighter market, you don't own a strategy, you own hope. Secondly, I'd be targeting cash flow resilience, not just buying into any yield. In a market that's moving this fast, it's easy to get seduced by growth and completely forget holding costs. But late cycle Perth will reward those investors who can hold their nerve when a deal sits for 3 to 6 weeks longer than expected, or when rates don't fall as quickly as the internet promised. So as a result, I prefer deals that are at least marginally positive or close to neutral after realistic expenses. And that might not be sexy, but it's how you stay in the game long enough to benefit from long-term compounding. Now, on the 12 to 15% growth view for 2026, I'm not saying that's guaranteed. I'm saying that it's plausible if two conditions hold. Stock stays tight and the demand base doesn't break. And right now, the data is telling us that both of those are still true. Perth is up over 7% over the last quarter alone. And if that kind of quarterly pace repeats itself even partially throughout 2026, you can see exactly how that 15% growth story becomes a realistic path. And remember, the key is selectivity, because if buyers are more selective, the average Perth number can look strong whilst mediocre assets start lagging. So guys, with all of that said, here's the clean takeaway. Perth hasn't changed its story, it has tightened it. Back in September, the setup was as follows: low stock, demand holding, prices rising. The only thing that was meant to soften it was spring listings. And here we are in December, and the data basically says that that didn't happen. In fact, listings stayed tight. In some snapshots, they're actually dramatically lower than same period last year. And demand, it didn't fall away. So the market, it repriced faster. And if you're data driven and selective, well, this is no reason to panic. It's a reason to get even more disciplined, because in markets like this, the upside is real, but the mistakes, they get very expensive. And guys, remember, I'm not your financial advisor. I'm just a guy on the internet who's obsessed with property data and trying to make it as usable as possible for normal people. Guys, thanks so much for staying right until the very end of the video. I really appreciate you watching. If you got value out of this, please hit the like button, subscribe, and I'll keep putting these updates out as the numbers move on throughout 2026. With that said, I'll see you in the next one.